Good morning and welcome to the Loungers PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to CEO Nick Collins. Good morning to you.
Good morning, everyone. Thank you very much for joining us for our results presentation for the 53 weeks ending 21st of April 2024. My name's Nick, I'm the CEO, and with me is Stephen, our new CFO. And apologies for being slightly late as well. I will just take you through an initial slide and then hand over to Stephen, who's going to go through some more detail on the finance side. I think it'd be fair to say that we're really pleased with our progress and believe that these results set out another year of record growth and outperformance. And this strong financial performance is consistent with the track record that we've demonstrated since our IPO 5 years ago. In terms of, we've seen record revenue up 24.7% to 353 million. Adjusted EBITDA on an IAS 17 basis of 44.2 million, up 29%. And importantly, we've seen that adjusted EBITDA margin increase from 12.1% to 12.5%. And alongside our performance in the mature estate, we continue to deliver the rollout. We've opened a record 36 new sites during the year, and those new sites continue to perform really, really well. Current trading remains strong. Like-for-likes are up 7.5% in FY24. And in the first 11 weeks of this year, we've seen like-for-like sales growth of plus 5%. So on that note, I'll hand over to Stephen, who's going to go through the finance side.
Morning, everyone. The first slide here I'll take you through is our 24 versus 23 performance. So this year, FY24 was a 53-week year, and that's only accounted for 2% of our overall EBITDA profit, so not material to our results. We generated FY24 revenue of £353 million, which was 24.7% up, and that was driven by the full year effect of our FY23 launches, of which there were 29, and of our 36 FY24 launches, and also of our LFL sales performance of 7.5%. We grew gross profit by 27.4% as a result of growing overall gross profit by 90 basis points, and that was 110 basis points of margin, offsetting 20 basis points of increased labour. We delivered IFRS 16 adjusted EBITDA growth of 25.9%, which was a margin improvement of 20 basis points. And because of the benefit of an improved rent as a percentage of sales, we delivered EBITDA IAS 17 growth of 29.3%, and that was a 40 basis point improvement. So overall for the year, we delivered profit before tax growth of 56%. Coming on to the next slide that shows our LFL performance, we delivered 7.5% LFL performance in FY24, as Nick said, and that was evenly spread through the year, 7.7% in the first 24 weeks, so very consistent performance there. And in the last 11 weeks, we've delivered 5% LFL growth, and that's been negatively affected by the football because we don't have screens in our sites, and slightly by the fact that we had an extra bank holiday in the previous year. I'll just quickly take you on to a slide that shows our overall LFL growth during the course of FY24 by cohort. So this is by the year in which the site was launched. And the really positive thing you can see here is the consistent LFL growth that we deliver regardless of when the site was launched. So if you think about the sites, the 55 sites that launched before FY15, we still deliver very, very strong growth there. The next slide takes you through the underlying margin improvement from FY24 since FY23, and the blocks on the right-hand side are the movements from our far left-hand block of 12.1% which was our FY23 EBITDA margin percentage, to our FY24 exit, which was 12.5%. So it tracks the 40 basis point improvement. And the 40 basis point improvement is from cost of sales, 90 basis points. And as I said, that's 110 basis points of cost of goods benefit, netting off against 20 basis points of labour cost. It's site fixed costs, positive 30 basis points. And our site fixed costs are our rent, our rates, and our labour charge. And that improved in the year from 4.6 of sales to 4.3 of sales. It's negative for energy by 30 basis points, and that's because we came out of a hedge that we took just post-COVID. So obviously we've had to lock into slightly higher rates, but we are now locked in on our rates until the end of September 2025. We then had negative of central costs, which was 30 basis points, and that was predominantly from increased bonus payments. And finally, we had negative variable costs of 20 basis points, which was maintenance costs. So overall, that gives us our 12.5%. And worth saying that that's slightly skewed towards H2, where we have the benefit of Christmas and where we made price increases in October that weren't accompanied by national living wage cost increases, because obviously they only happen every year in April. I'll just take you now onto a view of our margin outlook. And this is showing inflation continuing to moderate. So we've seen falling inflation in our food inflation, only 1% or less than 1% at the end of April. We have seen some marginal inflation in Q1 of FY25. And what we see is that continuing with some instances of particularly high inflation in certain categories. So we know, for example, that French fries will increase double digit. And that's very much in line with the story, the general narrative from CGA, the research consultancy that gives data on this information, albeit that we've performed better on inflation than the market. In drink inflation, we see that at about 3.3% and see a similar trend pervading for FY25. And on national living wage, there was a 9.8% increase in FY24, and we think we can mitigate that down to 6.5% as the cost increases or the wage increases going up to our salaried staff is lower than the national living wage. The next slide gives you an indication of how we hope to get towards our EBITDA margin target of 13.5% over the medium term. So it's an indicative view. And indicatively, we see some benefit coming through in food and drink margin, where we've negotiated a new supply contract and where we see further opportunities to optimize our supply chain. And we think that will offset any issues on site labour. So we know it's a slightly unsure environment at the moment as the new Labour government revealed their plans for national living wage. But we think obviously national living wage will exert upward pressure, but we've shown good ability to mitigate that in the past. On site variables, we see easing variable cost inflation, and we have certain specific projects to look at certain cost categories. So we hope to be able to improve there. On central costs, we think that our increasing LFL sales and our new site openings should allow us to leverage our cost base better. On energy costs, we think there will be a slightly adverse impact there because commodity prices are likely to increase, but we hope to offset that to a certain extent with usage efficiency. And on the point of site fixed costs, as our LFL sales increase during the course of the oncoming years, and in a relatively tenant-friendly property market, we hope to be able to keep those at worst at a constant level of sales. So that's broadly a sketch of how we would, over the medium term, endeavour to get back to our 13.5% original pre-COVID level. Coming on now to cash generation, we've had strong cash generation in the year. We generated cash of 47.1 million from operations, and that was 107% of IAS adjusted EBITDA, and that was because we got a working capital benefit as we roll out new sites. We've used that to fund our maintenance CapEx, so that's all of our non-new site CapEx, like our lounge kitchen reset, our splash and dash, our central CapEx, and that's left us with 35.4 million of free cash flow, with which we have funded our new site CapEx of 38.7 million, and from which we have repaid 12.5 million of our term loan. So that has left us with 10 million of positive cash at the year end. Going through onto our capital expenditure. So we, as I just referred, we spent 38.5 million on new site CapEx. That was 35.7 million on our 36 new sites. So 33 lounges, 1 Cosy and 2 Brightsides. We've then incurred 5.1 million pounds worth of CapEx on maintenance, and that's broadly in line with what, as a percentage of sales, with what we've seen in previous years. We've completed our kitchen works program and spent some CapEx there, and we've completed 14 splash and dash refurbishments at an average cost of 130k. And within that overall maintenance cost, we're maintaining our sites in very good condition so that we prevent the big peaks of CapEx that some companies incur as they develop their sites. Bringing you on now to the lounge, specifically the lounge rollout for FY24 and looking against that in FY23. I mentioned that we opened 33 lounges, and that was 9 more than we did in FY23. And in terms of the landlord incentives, they remain very attractive, up to 2 months on average to 26 months. We keep our lease length in line with prior years, so 15 years being the average lease length, and we're seeing an improvement in the rent to revenue ratio of that rent cost, going down from 4.9% to 4.7%. We have seen a slight increase in our average CapEx cost at 905,000, although when you exclude Ormo and Costero, so Ormo's our lounge in Llandudno and Costero in Paynton, that does come down to 875. And that 875 is slightly higher than last year. We've done slightly more covers, 6% higher per site, and we've had slightly more complex sites. So those are sites in heritage buildings or that are slightly bigger or potentially multi-site. But against that, we have delivered better average gross weekly sales on our FY24 sites. So average sales were 33.6k, and that was 9% better than in FY23 when we had average sales of 30.9. And worth remarking that that is significantly better than in FY19 when they were below 23k. And finally on that slide, we've delivered 30% CROCI, so that's cash returned on cumulative cash invested on those sites, so a really good target for us to hit there. Looking very quickly at an average maturity profile for our new sites, what I've done here is taken our cohorts from FY20, so just before COVID. We launched 16 sites, and the table that you can see on your right shows the profile of gross average weekly sales, EBITDA percentage, average annual EBITDA cash, and CROCI over the ensuing 3 years. So what typically happens in a lounge is we honeymoon for the first 6 to 12 weeks as people come and explore the site. There's a slight reduction in sales then in the next year as it settles down to its normal customer base. But then over the next 2 years, we get really strong double-digit sales growth. And that's what you see in that second row, going from 26.7 at the start of FY20 to 31.5 as we get towards more maturity. You see a similar improvement in EBITDA percentage. So the third row there, from 15.3% in FY20, growing steadily until we get above 20%. And worth noting there, that FY22 number of 18.4 is distorted by the business rates relief that happened after COVID. Average annual EBITDA increases very nicely from 206k in FY22 to 290, as does Crocky. So really positive profile as we launch our sites and as they grow towards maturity. And finally, just taking you towards our debt position at the end of the year. We ended the year with net debt of £9.7 million, which was slightly ahead of our 6.1 last year. But there we did fund our 47.7 million of capex, and we also paid back 12.5 million of our term loan, so that's now down to 20 million. But we exit the year with a really strong balance sheet, a very strong funding position. We've still got our facility in place to June 2026, so really well positioned to fund our future growth over the coming years. And on that, I'll hand back to Nick so he can take you through the strategy and operations.
Thank you, Stephen. So my first slide just talks through some of the highlights as we continue to deliver on the rollout strategy. And as Stephen has shown, decreasing inflationary pressures combined with our increasing scale is allowing us to make really good progress in terms of re-establishing that pre-COVID margin level. We've also seen record number of new site openings at 36, but despite that acceleration in the rollout, it's the constant food, drink and design innovation that continues to drive the sales growth across the mature estates. I'll talk in more depth about how we've invested further in the senior team and the operational structure to deliver the ongoing rollout. And we've got a really strong pipeline of new sites. And I think performance across the estate, both the mature estate and the new sites, gives us real confidence that that target of 665 sites across the UK is a conservative one. And we've seen both a strong trading performance in FY24 and over the first 11 weeks of this current year. So in terms of how the consumer's behaving and what the trading environment's like, we continue to have real confidence in the high street. And we haven't really seen any notable shift in or change in demand or sales mix or sales patterns over the course of the last 3 years. And if you think about our estate, over 260 sites across the UK now in England and Wales, we've got a really good spread. And there's no variation in terms of demographics or affluence or regionality at all. Thinking about our FY24 like-for-like sales, that growth of plus 7.5% reflects largely flat volumes and around 7 to 8% of price. And as we progress throughout the year, we anticipate a return to more meaningful volume growth. And that's as a result of us investing in our team and offer. And we remain really confident that we offer great value for money in all three brands and remain really competitive on the high street. And we haven't, yes, we've taken more price, but we haven't increased our prices in recent years to the same extent as other operators. Looking at the 11-week year-to-date like-for-like figure of plus 5%, it's slightly below where we finished last year at plus 7.5%. But just thinking about that, it's a really short 11-week period. And the May bank holiday, as Stephen said, the Euros, and I suspect the weather as well have had a marginally negative impact. But we very much expect that to even out across the year. It's exaggerated over such a short period of time. And every year we see some noise around bank holiday timing or the weather or national sporting events. Indeed, this time last year, when we were sitting here talking about the first 12 weeks of FY24, I think the like-for-like was around plus 5% again, and we delivered plus 7.5% for the full year. What's important is that all three brands are in decent like-for-like growth. That like-for-like growth in the lounge is pretty metronomic. Cosy can be more varied based on external factors, and it's very early days for Brightside. The next slide just looks at how the lounge sale profile has changed over the last 5 years. We thought this would be quite interesting. It's a slide that we haven't shown before. And just picking at some of these charts in turn, the top left there, looking at the food drink split, we've seen food sales, the food share increase by 5%. I think that's a function of us delivering food quicker, turning tables, really capitalizing on the investment that we've made in our kitchen systems. Looking at the next slide across on the top, which shows how our sales are split between brunch, lunch, dinner, and post-dinner. Again, you can really see the benefit of that all-day nature of what we do in the lounge business. I think one of the things I'd really highlights to me is the lack of importance of late night. Late night is a thing many people will be familiar. It's a struggling category. Bars are really struggling, but it was and remains a very small element of our sales at 1%. Moving across to the next, you can see how our trade split in the lounge business in terms of the days of the week, and 43% of our sales Monday to Thursday. And that's a really important factor in understanding why the lounge business is so successful. Many businesses have real reliance on Friday to Sunday, and their trade's very much dominated, whereas 43% of our sales are achieved early week. You can see in the food categories in the top right there, a slight increase in brunch, and then moving down to the bottom left, that chart shows our vegetarian versus meat dish sales and the split there. And we've seen slight decrease in the proportion of sales represented by vegetarian dishes. Maybe slightly surprising, but I think it also just reflects the reduction in popularity of some of those meat substitute products like Beyond Burgers. And then looking at our drinks, alcohol sales have shifted down from 60 to 55% of our drink sales. And then looking in the bottom right, you can see how hot drinks have really grown in terms of that split. And I think what we've seen there, that reduction in alcohol sales, is reflecting the fact that we've got a lot better at hot drinks, and in particular delivering coffee sales really well. During the year, moving on to the next slide, we've really invested in the lounge operational structure. And that's a significant investment in the lounge ops map, increasing from 5 to 8 regions. And the regions are a really important part of it's a really important part of how we control the sites. And the regional ops managers, it's a key level of responsibility and accountability within that operational structure. Smaller regions allow us to drive continued operational improvement and, really importantly, provide capacity for further growth. And a statistic that we talk about an awful lot is that ratio of sites to operators, currently at 4.2, comfortably, I think, the lowest in our sector. And having such a small number of sites for each of our operators allows them to spend more time in the sites, and also allows them to take up the considerable amount of work that's associated with us opening a site every 10 days. 75% of our operators were previously lounge general managers or head chefs. And that's a statistic that we're really proud of. We're quite unique in the progression opportunities that we can offer people in our business. And it's a really important underlying factor in the continued success of our business and the rollout. We've also invested in the regions in terms of each region now has committed regional maintenance resource, community resource, and recruitment resource working alongside our operators teams. And what that allows them to do is it allows them to really focus just on the customers and their delivery. And yes, we expect to benefit from leverage over our central cost base more in the short to medium term. I think if you look at our central costs as a proportion of sales, as Stephen pointed out earlier, we saw an increase from 7 to 7.3% in FY24. If you remove the impact of bonuses, then underlying central costs were flat at 6.8% of sales over both years. And we'd expect that central cost percentage of revenue to come down more significantly over the next couple of years. I think we acknowledge that in the last 6-9 months, we've invested quite a lot. Just touching on Cosy Club. Cosy Club continues to perform really well with fresh impetus around maximising covers, delivering strong like-for-likes, especially around those flagship days, as evidenced by Christmas. And Lucy, the new MD's had a really impressive impact there. Equally, it's a really exciting time as the brand as we look to build on that success and assume a slightly more premium position on the high street. And we're working hard on projects launching in the autumn to elevate the food and drink offer and drive hospitality excellence in our teams. Cosy Club's performing really well. It's got great like-for-likes, but our instinct is that we can premiumize it a little bit more and just take a little bit a little bit more sales. I think what's great is that we've now got the strength and depth within that existing senior team to undertake this project without causing significant distraction to other areas of the business. And thinking about the ongoing rollout of the Cozy Clubs, there are currently 2 in the pipeline, and we anticipate opening 1 or 2 new Cozy Clubs per year on an ongoing basis. And then on Brightside and the journey so far, sales have been really encouraging in terms of like-for-like growth. Exeter, the first site that we opened, we've seen the first site we opened, which has had any meaningful kind of growth post its first year anniversary, has been performing really, really well. And we're really pleased with the operational performance in that business. I was in there last Thursday, and it continues to be the case. Customer feedback's fantastic, and we're really proud of what we're delivering from a hospitality point of view. And we've invested further in marketing in the run-up to the key summer trading period to entice people in. We've got more signage on the approach roads, as you can see in that image there. We've got some advertising vans in the southwest and key high footfall areas. And then we're doing some quite fun cross-brand marketing to benefit from lounge and Cozy Club customers who are holidaying in the southwest. I think what we would say is it's still a little bit too early for us to talk about returns on Brightside or rollouts or size of the opportunity. From our perspective, it very much remains in the lab with a key summer ahead of it, and that's why summer's so important. I think it's more seasonal business, Brightside, and this year I think it's second summer. Understanding how those sales have grown, how familiarity's grown with people passing the Brightsides for a second time as they head down to holidays in the southwest. I think equally we're opening our 4th Brightside in the autumn. It's the only one that we've got in the pipeline, and it's in quite a different location. It's on the A1 up in Rutland, a very, very busy road, and equally it's in a new build property, whereas the previous 3 were in properties that were formerly restaurants. And we're interested to see how it opens where it's unhindered by any legacy impact. So coming on to talk about the new openings and the pipeline a little bit. As I mentioned, it's a record year of new openings, 36 sites. And as you can see from the map in the middle of that chart, really good geographic spread across the country, which is important from a balance perspective and us having confidence that we can deliver those openings well. And I'll pull out 4 sites here, which I think just really help reflect the different types of properties and the different types of locations where we're opening. Looking at the top left there, you can see Costero Lounge in Paynton, where we opened in December in what was previously a Harvester unit. We trade really well by the seaside. We had absolute confidence opening here, and it's absolutely smashed all records, achieving a record week for the lounge business with sales of 107,000 a few weeks ago, and average sales of 72,000. Bottom left there's a picture of Ivo Lounge in St Ives, and that's St Ives in Cambridgeshire, not St Ives in Cornwall, where we already have a site. We opened here in November in this unit that was previously a pound stretcher, and it's a much more typical town centre lounge. On the top right, you can see Pontio Lounge in Chepstow, where we opened in February, not far from our office here in Bristol. Chepstow, we've been looking for a site for a while. This was previously a local department store. I think what's interesting about Chepstow, population of 15,000, it really highlights how lounge can perform very, very well in locations with relatively low populations. Gross average weekly sales here of 36,000. There'll be a bit of honeymoon in that number. We'll expect it to come down a little bit, but it will trade really, really consistently with an average lounge. And then in the bottom right there, you can see Riparo Lounge in Westwood Cross. It's a great example of our success in some of these retail leisure schemes, where we've opened a few more sites in recent years. I think where we have real confidence that there's a strong retail and leisure lineup, and that might be a cinema, bowling, etc., alongside really good shopping and good retail footfall, the lounges trade really well in these locations. Next couple of slides is focus on specific sites, and the first one is a case study of Bordeaux Lounge in Carlisle, in the city of Carlisle in Cumbria, where we opened in October. I think what's interesting here is we always knew we'd trade well, and I think that gave us the confidence to pay a slightly higher rent at 77,000 and invest a bit more from a capex point of view, just under 1.1 million. That's paid off. It's a top quartile site, average weekly sales of 43,000 and a CROCI of 40.2%. I think what's interesting here is just a demonstration of how the property landscape's shifted over recent years. This really pretty site was formerly a top man within the Arcadia group. It was let to Arcadia on a rent of 240,000 a year. We're now paying 77,000 a year. Next case study shows Veraco Lounge in Bromsgrove, and if the population in Carlisle was over 100,000, population in Bromsgrove here 30,000, so smaller town. This was previously a Superdrug. I think it's a great example of how we really add value to our high street. It was a pretty drab shop front before, and we've completely shifted it around. I think made it look really good. This is a much more typical site. Rent of 40,000 is very competitive. Net capex of 867,000, more typical of the average lounge. And just looking at the map on the right-hand side there, and the retail and leisure lineup, very, very typical of the kind of locations where we operate. Boots, a Costa, supermarket, a Wetherspoons pub, a couple of banks. And thinking about the pipeline, future sites, it's in a really strong place, and the property market continues to be favourable. We've opened 8 sites so far this year. There's a further 46 in the pipeline, and we're now planning sites for year ending April 26, so the year after this one. Again, a good geographical spread, and we've got 5 build teams operating, and they're very comfortable opening 35, 36 sites a year. One thing I would point out, that average capex of 905,000 is our sense that there's an opportunity to achieve further capex efficiencies, and that's very much a priority of ours in FY25. And as hopefully the pictures have demonstrated, we continue to invest in our design and look and feel team to innovate and raise our game further. Touching on people, the second half of the year, we've kicked off a number of fairly significant L&D initiatives, the learning and develop initiatives, to further drive up retention. Of a bite-sized program for reworking how we induct our team, step-up programs for our assistant manager to general manager and for sous chef to head chef, and our future ops program, which formalizes and wraps up something that we were already doing very, very well. It's a big year for us this year from a learning and development point of view, and I'm excited about the impact it will have and look forward to telling you in 12 months' time how we're doing and the return on this investment. Lounge Fest, our annual staff party, we had our 10th one a few weeks ago, attended by over 4,000 people, continues to be the most important people, cultural investment that we make in the business. Our teams love it. And staff turnover has materially improved, both front of house and back of house during the year. And there's more that we can do, and this is something we talk a lot about internally, that the cost of staff turnover continues to represent the biggest efficiency opportunity on the P&L. Meaningful reductions or increases in staff tenure or reduction in staff turnover can flow right through to the bottom line. And we are building a senior leadership platform for continued growth. And there's been quite a lot of change in that senior team over the last 18 to 24 months. We've already met Stephen on the finance side, and the introduction of Justin Carter into the group MD role has been a really critical step that we've been thinking about for the last couple of years. I previously had 7 or 8 direct reports, and Justin now as group MD, he has the reports of the individual brand MDs. So Kate on the lounge side, Lucy on the Cozy Club side, and the Brightside brand as well. And what that does is it allows much more focused leadership and guidance of the brands, benefiting from Justin's significant experience. And it frees up me to focus more strategically as the business continues to grow and spend more time with the leadership on the finance side, on the commercial side, on the property side, and on the people side of the business. Just thinking about those 2 new brand MDs, Kate and Lucy, both landed really well in the business. Great cultural fit, and they're bringing experience and challenge into their roles. Stephen's now firmly in place as CFO and has really clear priorities, both in terms of business partnering, the operating business, and evolving our systems. I think we're really keen to point out the strength of our leadership team. We have confidence not just in delivering the continued rollout, but also alongside strategically challenging how we can leverage our scale, our team, our experience, and our combined passion for hospitality. As you can probably imagine, we've had quite a few questions over the last few days in the roadshow about the new Labour government and Labour's new deal for working people. And Labour, in their manifesto, stated their intention to make some changes to the laws around how our teams are worked and paid. And amongst those that really stood out to us were, I guess, banning 0 hours and limiting or employers' ability to change shifts at short notice. Further removing the national living wage or minimum wage age bands, and then talk of delivering a genuine real living wage where the minimum wage reflects the cost of living. I think the first thing we point out is that there's very little detail on these, nor proposed timing. And our sense is that nothing's going to happen particularly quickly. But our perspectives are, I think, in terms of that flexibility and banning 0 hours contracts, it's something that we're striving for, and I think it's something that we're very comfortable with. So, that's some work that's in progress within the business already. In terms of increasing minimum rates of pay and indeed removing age bands, I think over the last few years, we've got really used to kind of very high wage inflation as a result of increases in the national living wage. Last 2 years, we've seen plus 10% increases in national living wage. And indeed, in March just gone, we saw the removal of the under 23 age band. And I think we're fortunate. We're a big business. We're benefiting from increase in scale. And I think we've demonstrated that we're able to mitigate and absorb those significant increases in national living wage. So if Labour do follow suit, and that is their course of action, then I think we're comfortable that we can mitigate it. I think what we would point out is that it is really fueling inflation, these increases in national minimum wage, and indeed it does make life for much smaller businesses a great deal more challenging. On the flip side, clearly increases in national living wage will put more money in our customers' pockets and will have a positive impact on our sales. Moving on to the next slide, and looking at the 5 areas around which our good stuff strategy is built, starting on the left and just thinking about community. Community is absolutely fundamental to the lounge business and something that we talk about an awful lot, bringing joy to local places and our positive contribution to communities across the UK. We're well on track to deliver over 10,000 community events this year. And we've introduced a new community fund where each site is provided with £1,000 a year to support their local community. And that will be in individual projects chosen by that site team or chosen by their customers. And that might be through the team volunteering their time to help local causes, or indeed donating food or drinks or providing cash. On the people side, I mean, we've talked a lot about people already and succession planning and progression in the business. And in terms of customers, we're really proud of what we put on the plate, and that average of 18 vegan and 36 gluten-free dishes on our menus. So gluten-free and vegan and vegetarian dining, really important aspects of what we do. And in terms of the planet and how we deliver hospitality sustainably, we've launched major waste and energy efficiency campaigns across the whole estate, partnering with external experts. And then from a supplier point of view, we're working with our partners to raise standards, with 91% of our food and drink suppliers now registered on SEDEX, which is the Supplier Ethical Data Exchange. And what that allows us to do, it gives us the reassurance that our supply chain is behaving responsibly and ethically. So just coming on to conclude, we're delighted to have delivered another record year, and we'll always point to, I think, the consistency of our performance and the fact that, despite the fact that the rollout's accelerated a little, the performance within the mature estate continues to go from strength to strength, as does the level of sales and levels of EBITDA in our new site openings. and we firmly believe there are exciting opportunities ahead for all three of our brands. We're a better business for having three different but complementary brands, and I think that's really important. Sometimes we've received a little bit of criticism about Brightside and whether there's a risk of distraction. I really think these numbers demonstrate that we haven't been distracted and that the performance in the core estate is just getting better and better. We've reshaped and strengthened the senior team. I think one of our core strengths has always been thinking about how do we need to look in a year, or how do we need to look in 2 years when the business is much bigger, and taking those decisions now to make sure we're prepared for that increase in growth. And as I said, changing government and their stance on our sector is not clear. I think we're really keen to have a government that's supportive and shouts for the hospitality sector, keen to see reform to business rates, keen to see reform to the apprenticeship levy. And equally, I think we recognise the need for the government to protect smaller businesses in our sector, because they have a really important role to play in the continuing success of the high street. So that's the end of the formal presentation. I think we now move to answer questions.
That's great, Nick, Stephen. Thank you very much indeed for your presentation. I will now bring your cameras back up for the Q&A. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated in the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Nick, Stephen, as you can see, we have received a number of questions throughout today's presentation. And if I may now hand back to you to kindly ask you to read out the questions where appropriate to do so, and I'll pick up from you both at the end.
Of course. So we'll just run through. Gary's asked, with 36 new sites opened in FY24, how do we assess the performance and profitability of these new locations compared to existing sites? I think hopefully you might recall the slide that Stephen showed earlier in the presentation, which showed the maturity profile of the FY20 cohort, so sites that we opened 4 or 5 years ago, and what we're seeing in terms of new sites and the 36 that we opened in FY24 is we're seeing higher levels of average sales, higher levels of EBITDA, but real consistency in terms of that maturity profile. So honeymoon opening, but then a slight dip after honeymoon opening, and then straight into like-for-like growth, and then we see that flowing right down to an improving EBITDA and CROCI. So real consistency, but performing a little bit better. Christopher asked how we're planning to tackle ongoing inflationary pressures, especially concerning labour costs and national living wage increases. Stephen, do you want to?
Yeah, I mean, I guess we always take a balanced view between maintaining the profitability of the business and of maintaining the right customer offer. I mean, if you look at our history of tackling inflationary pressures, we have been very successful at doing that. We've talked about earlier on about how we've managed the spread of the national living wage from 23-year opening age down to a 21-year, and therefore that's really a core competence of the business. We look at our cost profile, we look at our overall profitability of our sites, and we make sure we maintain those in balance. But we think as we look over the coming year, we will be able to manage to balance those two things: the overall profitability of the sites, the level of pricing that we have in our menus and our selling prices, and the balance between the costs that we're incurring.
Okay, and Richard asked, your focus on staff retention sounds great. Please could you give us some colour on exactly what you're doing from a learning and development point of view? Say I'm a server, front of house, what will you do for me to help my journey to GM, general manager, mentors, 12 hours of video training? What specific things are you doing? As we said, I think this is such a core strength of our business, and one of the things we're probably most proud of. I think that we can take young people and give them opportunity really quickly if they want a career in hospitality. And there are countless examples right across the business people who've been on that journey. And what I think we've tried to do this year is or in the last 6 months is formalize it a little. So we're really good at it. And the risk in a business like ours growing so quickly is that you get lots of people doing things slightly differently. And so we've tried to wrap that up. And I talked earlier about the bite-sized program and the step-up programs and the future ops programs. So what we've done in the last 6-9 months with bringing Guy, our chief people officer, has been leading the charge on, is just trying to wrap it up a little bit and formalize it. But in doing that, I think what's really important is not, we're quite the business has got quite a strong non-corporate ethos. And I think it's important, we can't become too branded and too corporate and too kind of formulaic. So it's a balancing act. But if you're a young front of house person, then you'll be really encouraged to become a supervisor quickly. From that point onwards, we've got some more formal training in terms of how you get to become an assistant manager, and then a general manager, and then an ops manager. And yeah, we do a lot of listening as well across the business. Lots of surveys. We're really open, and I often say to people, both individually and if I communicate to the business as a whole, if you feel you're not being listened to, or if your career is not being treated with the kind of respect it deserves, tell us, and we'll do something about it. David asks, are there any specific market trends or consumer behaviors you are closely monitoring that could influence your strategy? It's a good question. I don't think so. I mean, an example. I mean, as an example, there's lots of small things. So the great thing about all three of our brands is that we're not wedded to any specific cuisine or any specific drink or region. We can sell within reason whatever we want, and that's put us in a really strong position over the years. And if I look at the menu in Lounge, for example, now it's parts of it are very, very different to the menu we had 10 years ago, indeed 20 years ago. And yeah, the menu now, we've seen a lot more Middle Eastern flavors come in. There's more Asian dishes. There's more spice. And so we react to trends in food and drinks. Another example would be Guinness. So we're currently trialing, we haven't historically sold Guinness. Guinness is really popular at the moment. We're currently trialing Guinness in a number of sites with a view to rolling it out. I think one thing that, the great thing about having a business that's as big as ours now is that we can trial stuff. So if we've got if we've got an instinct or, just an itch that we want to scratch, then we can give it a go in a site and see what impact it has. So hopefully that answers that question. Richard asks, volume versus price. Given you've taken lots of price, not as much as others granted, would this be at the expense of volume? What things give you confidence volume will return, especially given you don't really run extensive email offers or large marketing campaigns to get people back through the door? I could ask the person who's deleting the questions not to delete them quite so quickly, because my memory's not good enough and I can't I can't quite remember them. But what gives us confidence? I think clearly the fact that we have taken more price recently is likely to be a little bit at the extent of the expense of volume. What gives us confidence that we're going to see a return to volume? I think the way I think about it is, and the way we talk about it in the business, and just to be clear, it's recently just started our new financial year, and that's quite a good time in a business like ours to remind the senior leadership team, the senior team, about what our priorities are for this coming year. And our number one strategic priority for this year is within the business, a return to more meaningful volume growth. So it's something that everyone's very, very focused on. If I look across our estate and you look at the performance of the sites, we've got some sites and some operating areas which are in really good like-for-like double-digit growth. And then we've got some areas which are in lower like-for-like growth, kind of lower single-digit like-for-like growth. What's great about our business is looking at it now is that all the factors affecting performance are internal. There aren't any external factors which are driving, maybe with the small exception of one or two sites, but there aren't really external factors affecting it. It's got nothing to do with competition. It's got nothing to do with demographics or demand or the way the consumer's behaving. It's all about us. and our performance, and that's typically people related. And so if I think about how we've invested in our operation structure, how we've invested in the resource that we're giving our operators, we've given them every opportunity to match for the bottom half to match the top half of the estate in terms of performance. So you're right, we don't have extensive email offers or marketing campaigns, but at the end of the day, I don't think performance in our business isn't necessarily about how we shout out to people and try and get, it's much more about how we deliver our hospitality, how efficient we are in terms of speed, in terms of turning table, how our familiarity is with our customer base and that local community. Those are the things which really influence sales growth within our individual sites. Sorry, I'm just going to go past there. So Richard asks, I've been surprised that some investor analysis on lounges focuses on metrics like profit before tax. This seems completely to miss the point about your rollout. Could you explain why the restaurant industry and yourselves focus on IAS 17 EBITDA? Well, I'll start to answer that question, and Stephen can tell me if I get it wrong. But I mean, you're right. I mean, the hospitality sector has forever looked at EBITDA multiples, and in the old days, a hospitality business, a decent one, much like ours, would have been valued around 10 times EBITDA, 10 times run rate EBITDA. I think in recent years, we've seen that multiple kind of reduced down to 8.5 or something. And if you look at our multiple of a run rate, we're probably sub 6 on the way that we're currently valued. So it looks very cheap. And then equally, we see lots of investors who point to our PE ratio and suggest that we look expensive on a PE basis. But clearly, the rollout and the fact that we have a higher depreciation charge because we have a very immature group of sites, because we're always opening new sites, I think is an important factor there. So I personally will always look at run rate EBITDA multiples. That is where we focus. It's cash equivalent. Does that sound sensible?
I think it's very sensible. And as an accountant, I don't think the accounting profession has done a great service to the hospitality business. This IFRS 16 that capitalizes future rents has, I think, thrown a lot of the analysis into confusion. But exactly as Nick says, EBITDA is a really, really good surrogate for cash generation in our business. But as the question points out, it only ever captures what we've done today. It doesn't capture the full year effect of the sites that we've got in train that will now have an extra 1 to 11 months of trading the following year, nor does it look at the enormous opportunity we've got in our business through that 600 plus site rollout. So I have a lot of sympathy with the question.
I think one thing I would say is that we've been it's over 5 years since the IPO now, and I think when we did IPO, I think there was a degree of skepticism and around the business and our track record and a lack of awareness of who we are, not having a presence in London, etc. Were all factors. I think if we look at the last 3 or 4 years, I think the trust and reassurance that we've built among the investment community has grown, and I think and hopefully that's reflected a little bit in the share price as well. I think is that the last one. Michael asks, what's our average lease length? I can answer that one. 15 years. Are there any more there? Did we miss any? Oh, no, so we've gone to the bottom. Are loyalty schemes on the radar? Assuming that's from a customer point of view, no. In short, I mean, the way we think about loyalty schemes is rather than having a card where you kind of stamp 6 times and get a free coffee, we think about loyalty, and we have random acts of kindness. So we encourage our teams to give stuff away to customers, and obviously we put controls around that to make sure they don't do too much of it, and they record it, etc. But we say to our teams, if you see someone come in and they're having a really good day, they're celebrating, or if they're having a really bad day and they're sad, or indeed if you just fancy them, feel free to give them stuff, because the impact that can have on someone's day and someone's mood is amazing. We feel that's a much more natural way for our teams to engage with their customers, rather than the kind of formality of a formal loyalty scheme. James asks, do we expect to see further optimization in the supply chain, and can we expect to see the sustainable sales growth continue at this level? So I think that's two there. In terms of further optimization in the supply chain, yes, absolutely. We're on that journey in terms of taking kind of logistics cost out of our supply chain by reducing the number of wheels on the road, etc. Yes, we do. I don't think we'll go too quickly because it has operational impacts and impacts on our team. But clearly, one of the benefits of us growing in scale is both we can buy better and achieve economies of scale that way, but equally we can move to more advanced logistics models, which can take cost out of the supply chain. And can we expect to see the sustainable sales growth continue at this level? I think if you look at our track record over the last 10 years, we've really consistently delivered 6-7% like-for-like sales growth, and it's our belief that we can continue that. We might check, see if we've not answered any questions. Oh yes, we do. Richard says, you have a great geographic spread, but also great diversification of types of locations. Into FY25 and 26, are you skewing slightly to any specific themes? For example, you seem to be smashing it in coastal locations. We love trading in coastal locations, and we've got one coming up in Tynemouth in the next couple of months, we'd love to open more sites in coastal locations, and we've got other opportunities which are on the radar. I think, and equally, I mentioned earlier, we do more those mixed-use retail leisure schemes alongside our bread and butter, which is kind of towns and secondary suburban high streets. We try to balance the pipeline such that it's a good mix of geography. That's probably our number one kind of criteria when we're looking at sites. Yes, hopefully that answers that question. Richard asked, what are our top 2 or 3 learnings from Cosy Club Harrogate? For those not familiar, earlier this year we closed our site in Cosy Club Harrogate. This was really disappointing. It's the 8th site that we've closed in our 22-year history. 2 of those were end of leases on very small sites. So the way I think about it is that there were 6 mistakes we've made, and Harrogate was our 6th mistake. It traded for about 18 months. What are our learnings? I think why did we get it wrong? I think what we did, the pitch of the site was wrong. It was on a more daytime retail footfall pitch. It was too far away from the evening pitch, and daytime sales were okay, but evening sales were very poor. If I think about when we went into Harrogate, we know from the industry that Harrogate's difficult, and it's a lovely town. It's a small town with a very strong food and drink offer there. Lots and lots of operators there. And there are winners and losers, and that's very clearly defined more than perhaps in other locations. We were perhaps a little arrogant in terms of rushing into a site. We didn't do enough kind of on the ground research, didn't think about it enough, presumed that we would be fine, and we weren't, and really frustrating. And I think it's definitely caused us as an exec board to challenge our sites when they come in front of the board, to make sure that from a pitch perspective, we're really confident.
Fantastic. Nick, Stephen, I believe you have gone through all the questions from investors today, so thank you for that. But Nick, before redirecting investors to provide you with their feedback, which I know is particularly important to the company, could I please ask you for a few closing comments?
Yes. Well, listen, thank you very, very much for joining us today. I think we're at pains to point out it's another really consistent performance from Loungers, both in terms of the mature estate and the like-for-like sales growth and that focus on evolution and hospitality in the mature estate, alongside a record number of new openings, 36 sites, new sites opened, and we have real confidence in the pipeline. And the rollout as we're going forward, and our ability to return to pre-COVID levels of conversion. Thank you very much.
Nick, Stephen, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Loungers PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.